Hello guys and welcome to Simple Trade. I'm glad you decided to watch this video today. This is the first lesson out of 8 doing in which you will learn the simplest method of how to trade on the stock exchange. First of all, let me introduce who we are. Simple Trade is a trading school that offers day and swing trading online courses. The trading school was founded in 2009 by David Rose with the aim to enable anyone and everyone who may seek and is serious about achieving financial independence. We have done this by creating a system to help novice traders get the knowledge and the experience they need to survive and profit in the fast-paced world of day and swing trading. We have students all around the world who have already completed their training and are now trading by themselves and earning a living as traders. During the 8 lessons, we will discuss about what is day trading, technical analysis, the current way of reading the charts. We will also talk about the level 2 candlesticks, bullish and bearish patterns, the importance of the stop loss, time intervals, risk management, and much more in order to help you succeed as a trader. After watching all 8 videos, I'm sure you will understand the world of trading in much deeper and necessary depth. Stocks are just one of many possible ways to invest your hard-earned money. So why do people choose stocks rather than the other options, such as bonds, currencies, or maybe antique sports cars? It's actually quite simple. The reason why many people invest in stocks is because stock trading provides the highest potential returns, and in the long term, no other type of investment tend to perform better. On the other hand, stocks tend to be the most volatile investment. This means that the value of stocks can drop overnight. Therefore, as a day trader, because you don't leave any position open overnight, you are not exposed to unnecessary risks such as overnight gaps or global events that may affect the markets. In order to trade the markets, there is no need for a huge capital. With an account of only few thousand, you may generate a respectable and wise return. The process of learning will not always be easy and will involve overcoming many milestones on the way and even losses. But if you will learn from each loss and strengthen your trading skill, the road to success is just around the corner. Swing is another trading style that we teach, a trading style that aims to capture a movement of a stock in a period between several days to a few weeks, and other trading strategies and skills are required in order to master this trading style, including fundamental analysis and more. In the future, by combining swing with day trading, will help you to achieve much higher returns and balance in your portfolio. Of course, I will elaborate on this subject more during the lessons. In fact, the stock exchange is a regulated market like any other market, where people buy and sell financial assets, as in shares of companies from different fields, ETFs, bonds, warrants, and so on. The stock exchange intermediates between buyers and sellers, and with the modernization of today's technology, in most of the stock exchanges, the trades are executed by computers. When buying a share of a company, you are basically buying a piece of the company. The purpose of the stock market is to raise capital for companies. Companies go public so that they may increase capital in order to invest in research, development, and more. Before the establishment of the stock markets, companies used to turn to banks in an attempt to try and get a loan, or they would approach private investors and try to persuade them to invest in the company. How are stocks born into the world? The moment that private company wants to grow and develop and it needs to raise more capital, the company may choose to go to the banks and ask for a loan. Yet in the end, the company will have to return the money plus interest. May the company choose to approach a private investor, the investor's holding will give him the upper hand and the right to change and influence the company, since once he invested a large amount of money, in return the company gives him a percentage of the company. So, in fact, the stock exchange solves both problems for private companies that want to grow. But how does a private company turn into a public company? Through an IPO. What is an IPO? IPO stands for Initial Public Offering, and it's the first time that a company sells its shares to the common public. By doing this, a private company transforms from private to a public company. First and foremost, a private company decides it wants to raise a big amount of money in order to expand its activity. The company will then ask fund, banks, and private investors for an investment or a loan. Yet, but at a certain point, it isn't enough, and they need more, so the company decides to go public. The company then asks banks to act as an underwriters. The bank gets the opportunity to market the company's shares and therefore receives a commission in return. The underwriter is also the one who takes care of the registration at the stock exchange. The underwriter will then go on a roadshow with the attempt to market and increase the interest of the company's share to private investors, funds, etc. The first trading day of the company's stock on the market is private for institutional bodies. The second day is when the IPO goes public. During the issuance process, we as traders are exposed to institutional investors. These investors are in fact financial institutions such as banks and investment houses with large capital. These institutional bodies are the ones who buy the large number of shares amounting to billions of dollars and basically are the main market movers. In general, to earn profit by trading on the stock exchange is very simple. All you need to understand is that the stock exchange, as like every other market, runs on a matter of supply and demand, just like the milk or bread you buy at the grocery store, or a phone or a car. The supply is the quantity of products and services available in the particular market, and the demand is an estimate of the degree of demand for the products and services in the particular market. After the IPO process, the company's shares are traded on the stock exchange. From this point, the company's shares are traded between buyers and sellers on the open market of the American Stock Exchange and no longer belongs intentionally to the company. It now belongs to the public and it trades from hand to hand. Once a buyer and a seller agree on a share price, a transaction is made. At any given moment, the share price may change, and this change is the profit or loss. In order to measure the value of stock, we use technical analysis and fundamental analysis that I will elaborate on more during the next few lessons. Okay, so far this was the introduction to the stock exchange. I would like to take a minute to pause and address an important subject that needs to be said at this point. Did you know that 90% of traders do not end the year profitable? 90%! We as humans want to earn big and fast. We are also controlled by emotions. Our job as traders is to work with reason, using our mind and not be controlled by our emotions. Therefore, there is need to learn how to separate your emotions from the logic. This may be a learning curve process in which you must find a way within yourself to know how to separate between the two. During the next few lessons, you will learn a number of methods to help you understand and deal with the challenges of the profession. You must understand that in order to be a successful trader, money should not be your goal, but to master the means, and therefore your trading vision and purpose must be defined from the start. Ask yourself this: why do I want to trade? Is it because I would like financial independence? I would like to work less hours a day? Perhaps I would like to start a saving accounts, buy a house. Once your goal is properly defined, you must root it into your work plan. Because without a work plan, the greater the possibility for you to become part of the statistics of the 90% of people who end the year with losses. And remember, feelings and quick impulse are the cause of mistakes, and our role as trader is to act by mind and logic and not emotions. The first step in order to know how to understand charts is to know how to recognize the direction and the trend. Charles Darwin developed the trend theory that addressed not only technical analysis and price action, but also the market's philosophy. We read and analyze the chart from the left to the right. To determine the direction, you must look at the starting and the end point. It's also possible to draw a line and make it more obvious for the eye. The trend analysis is based on historical price movements, and there should be a consistent movement to determine a trend. Take a look at the chart and look at the uptrends marked in green. As the price actions move up and retreats, moves up and retreats, or pull back, each high will be higher than the former one, and each low will be higher than the previous one too. There may be minor exceptions as the trend continues, but overall, this is how an uptrend will look like. On the other hand, when each low is lower and each high is lower as well, is a chart pattern of a downtrend. You may see them marked on the chart below in red. The uptrend consists of at least two higher highs and two higher lows, and a downtrend consists of at least two lower highs and two lower lows. A sideways trend is a trend that cannot be determined because the price is trending in the range of between the support and resistance level, a subject we will approach in the next lesson. Therefore, the share's price move in sideways. And once the price of the stock moves sideways, we cannot predict whether the share will rise or fall. In our method, we always looking for the trend and proven direction. Once the stock starts to move sideways after an increase move or a decrease, and the prices are consolidating, it concludes as a kind of conversation between the buyers and the sellers in order to evaluate the value of the share. Now let's try to do some examples together. Is there a trend in this chart? What is the trend? An uptrend, a downtrend, or a sideways? This chart shows a repeat action of a higher highs and higher lows. So this is an uptrend. And what about this chart? Is there a trend here? This chart shows a repeat actions of a lower highs and lower lows. If we draw a line from the starting point till the end, it can be more visual that this is a downtrend. In order to get the eye used to the charts and to understand how to read the chart from the start, and before beginning the whole process, we have developed a method in the ways of homework so that you can do it by yourself. You may send us your homework and we'll help you get a better understanding of trading. Write your vision and wants on a piece of paper. Think well and focus on what you really want to achieve. And what is the big goal of why you've come to trade on the stock market? Find 5 charts with an uptrend. Find 5 charts with a downtrend. Find 5 charts with a sideways trend. And just mark up the highs and the lows of the trend like I showed in the lesson. The homework can be sent to our email. We will view your work and answer any questions you might have so we can accompany you through the process. In the next lesson, we will learn what are the support and resistance levels and how we can use them to predict price movement. We'll talk about types of charts, how to exit position if it's not going in your direction, and how to receive a profit using the stop loss order. We will also address the importance of this order, and we will go into the root of shorting a stock. If you have any question, you might contact us or leave a comment below, and we will be more than happy to assist and help each one personally to learn our way of making trading simple. Until next time, trade simple.